So, good morning, everyone. My name is Alexander Young, and today I'm with my friend Matthew. We will explain to you about International Accounting Standard 8. Is accounting policies, changes in accounting estimates, and errors. So, the objectives prescribe the criteria for selecting and changing accounting policies, together with the accounting treatment and disclosure of changes in accounting policies, changes in accounting estimates, and corrections. Next one is disclosure requirements for accounting policies. Those for changes in accounting policies are set out in IS 1 presentation of financial statements. How about the scope? The scope are first, shall be applied acting and applying accounting policies and accounting for changes in accounting policies, changes in accounting estimates, and corrections of prior period. Next one is the tax effects of corrections of prior period errors and of retrospective adjustment made to apply changes in accounting policies are accounted for and disclosed in accordance with IAS 12 income taxes. So, the definitions. Accounting policies are the specific principles, basis, convention, rules, and practices applied by an entity in preparing and presenting financial statements, and also monetary amounts in financial statements that are subject to measurement uncertainty. Okay, so next one is the entity's financial statement for one or more prior period arising from a failure to use or misuse of reliable information. That first one was available when financial statements for those periods were authorized for issue. And second one, could reasonably be expected to have been obtained and taken into account in preparation and presentation of those financial statements. Okay, so I will explain this one by one. First one is retrospective application. Is applying a new accounting policy to transactions, other events, and conditions as if it had always been applied. Second one, retrospective restatement is correcting the recognition, measurement, and disclosure of amounts of elements of financial statement as if a prior period error had never occurred. Third one, impracticable. Applying a requirement is impracticable when the entity cannot apply it after making every reasonable effort. And the last one is prospective application of a change in accounting policy and of recognizing the effect of a change in accounting estimate respectively are. First one, applying the new accounting policy to transactions, other events, and conditions occurring after the date as at which policy is changed. And the next one is recognizing the effect of the change in accounting estimate in the current and future periods affected by the change. Next is management shall use its judgment in developing and applying an accounting policy that results in information. That is first one, relevant to the economic decision making needs of users. And the next one, reliable in that financial statement first represent faithfully the financial position, financial performance, and cash flows of the entity. Then reflect the economic substance of transactions, other events, and conditions, and not merely the legal form. Next, are neutral, free from bias, are prudent, and complete in all material respects. Okay, next is sources in descending order. First one is the requirement in IFRS dealing with similar and related issues. And the next one is the definition, recognition criteria, and measurement. That's liabilities, income, and expenses in the concept of framework for financial reporting. Next one is changes in accounting policies. An entity shall change an accounting policy only if the change first required by an IFRS. Second, result in the financial statements, providing reliable and more relevant information about the effects of transactions, other events, or conditions on the entity's financial position, financial performance, and cash flows. Okay, following are not changes in accounting policies. First one is the application of an accounting policy for transactions, other events, or conditions that differ in substance from those previously occurring. And the next one is the application of a new accounting policy for transactions, other events, or conditions that did not occur previously or were immaterial. Okay, applying changes in accounting policies. Subject to paragraph 23 in IS, which is first, an entity shall account for a change in accounting policy resulting from the initial application of an IFRS in accordance with the specific transitional provisions, any, in that IFRS. And the next one, when an entity changes an accounting policy upon initial application of an IFRS that does not include specific transitional provisions applying to that change or changes an accounting policy voluntarily, it shall apply the change retrospectively. So the next one is the disclosure. When initial application of an IFRS has an effect on the current period or any prior period, would have such an effect, except that it's impracticable to determine the amount of the adjustment, or might have an effect on future periods. An entity disclose. First one, the title of the IFRS, the change in accounting policy made in accordance with the transitional provisions, the nature of the change in accounting policy, description of the transitional provisions for the current period and each prior period presented to the extent practicable the amount of the adjustment. And the last one is the transitional provisions that might have an effect on future periods. Okay, when an entity has not applied a new IFRS that has been issued but is not yet effective, the entity shall disclose the first one, this, this fact that is not yet effective. And the second one, known or reasonably estimable information relevant to assessing the possible impact that application of the new IFRS will have on the entity's financial statement in the period of initial application. Okay, in complying with paragraph 30 in IS 8, an entity considers disclosing first one, the title of the new IFRS. Second one, the nature of the impending change or changes in accounting policy. Next one, the date by which application of the IFRS. The last one is the date as at which it went to apply the IFRS initially. Okay, so the next slide will be explained by my friend Matthew.
Okay, let's begin into the next part. So the next part is about accounting estimates defined. So the definition is an accounting estimate is a monetary amount within financial statements that is subject to measurement uncertainty, and they are utilized in instances where accounting policies require items to be measured at values that cannot be observed directly. And to achieve the objective of the policy, an entity must develop an estimate. As explained in paragraph 32A, the development of this estimate is a formal process involving measurement techniques and inputs, which relies on management's judgments and assumptions, which must be based on the latest available reliable information. An example is allowance for expected credit losses, net realizable value of inventory, fair value of assets or liabilities, depreciation expense, provisions for warranty obligations. Next is changes in accounting estimates. Paragraph 34 outlines the basis for revising an accounting estimate, which states that a revision is warranted following a change in circumstances upon which the new estimate was based, the availability of new information, the occurrence of a new development, or simply the acquisition of more experience. By its very nature, a change in an accounting estimate does not relate to prior periods. And the fundamental principle, also from paragraph 34 and expanded in 34A, is that a change in an accounting estimate, including the effects of a change in an input or a measurement technique, is an adjustment resulting from new information. It is, by definition, not the correction of an error. And finally, paragraph 35 says that a change in the measurement basis applied is a change in accounting policy, not an estimate. However, when it is difficult to distinguish between the two, the change is treated as a change in an accounting estimate. And then the next part is about applying these changes in accounting estimates. So, as said in paragraph 36, 38, the method of required that we change this accounting estimate is through prospective applications, which means that the effect of the change is recognized in profit or loss in the current and future periods as appropriate. And prior period financial statements are not restated. And lastly, the change is applied from the date it is made. Paragraph 38 also provides further detail, which sets that a change may affect only the current period's profit or loss, such as a change in the allowance for expected credit losses. In other cases, it may affect both the current and future periods, just as a change in the estimated useful life of a depreciable asset, which affects depreciation expense for all subsequent periods. And finally, in paragraph 37, it states that to the extent of a change in estimate gives rise to changes in assets and liabilities or relates to an item of equity, it is recognized by just adjusting the carrying amount of the related item in the period of the change. Here is an example of revision of an asset's useful life. For this scenario, the asset cost of $100,000 with an initial useful life of 10 years gives an annual depreciation of 10,000 using a direct line method, and the carrying amount after 3 years will be 70,000. And the revision is that the asset's total useful life is to be 12 years instead of 10. And the prospective calculation will set that the remaining carrying amount of 70,000 after the depreciation, and then we will divide it by the remaining useful life of 9 years after 12 total years in the revision minus 3 years that have passed. And then the revised annual depreciation would be $7,778. Okay, the next is disclosure requirements, which is changes in estimates. So paragraph 39 and paragraph 40 says that a specific disclosure must be made. In paragraph 39, it requires an entity to disclose the nature and amount of a change in an accounting estimate that has an effect in the current period or is expected to have an effect in future periods. Paragraph 40 adds an important condition. If the effect on future periods is not disclosed because its estimation is deemed impracticable, the entity is required to disclose that fact explicitly. And then the next is the nature of prior period errors. So paragraph 45 defines this as omissions from and misstatement in an entity financial statements for one or more prior periods. Crucially, they arise from a failure to use or the misuse of reliable information that was available when those financial statements were authorized for issue and could reasonably be expected to have been obtained and taken into account. And the key distinction is that these are corrections of non-discretionary mistakes, not revisions of discretionary judgments. As paragraph 41 has stated, financial statements do not comply with IFRS if they contain either material errors or immaterial errors made intentionally. Some examples are mathematical mistakes, errors in the application of accounting policies, oversights or misinterpretation of facts, and fraud. And the next is accounting treatment for errors. So the required method of correcting the material prior errors is specified in paragraph 42 through a retrospective restatement, which requires the entity to correct the financial statements to present them as if the error had never occurred, which achieved by 1, restating the comparative amounts for the prior period in which the error had occurred, or 2, if the error precedes the earliest period presented, restating the opening balances of assets, liabilities, and equity for that earliest period. And paragraph 46 adds that the correction itself is excluded from the profit or loss for the period in which the error is discovered. And any historical summaries of financial data are also restated as far as back as practicable. Okay, next is limitation on retrospective restatement. So, paragraph 43 through 48 provide a critical exception to full retrospective restatement. Paragraph 43 states that an error shall be corrected retrospectively except to the extent that it is impracticable to determine either the period-specific effects or the cumulative effect of the error. And paragraph 44 and 45 detail the procedure. It says that if determining the period-specific effects on comparative information is impracticable, an entity must restate the opening balances for the earliest period for which restatements is practicable. And if determining the cumulative effect of the error on all prior periods is impracticable, the entity must restate the comparative information to correct the error prospectively from the earliest date practicable. And finally, paragraph 48 reiterates a crucial point, which is the corrections of errors should be distinguished from changes in accounting estimates. And estimates by their nature are approximations that may need to be revised as additional information becomes known. And such revisions are not a correction of errors. Okay. Next is a disclosure of prior period errors. So, in paragraph 49, it is stated that when an error is corrected, an entity must disclose the first, the nature of the prior period error, second, for each prior period presented, the amount of the correction for each financial statement line item affected, including earnings per share if applicable, and the third, the amount of the correction at the beginning of the earliest prior period presented. And lastly, fourth, if full retrospective restatement was impracticable for a particular period, the circumstances that led to that condition must be disclosed along with a description on how and when the error has been corrected. The next is guidance on impracticability and hindsight. So, when the paragraph 450 says that it can be impracticable to adjust comparatives. For example, if data was not collected in a way which allows restatement and it cannot be recreated. The core principle found in paragraph 52 and 53 is the prohibition of hindsight, which means that when making a retrospective restatement, it is imperative to distinguish information that provides evidence of circumstances that existed at the time of the transaction or error from any other information. And paragraph 51 notes that the objectives of a retrospective estimate remains the same as for a current one, which is to reflect the circumstances that existed when the transaction occurred. However, if it is impossible to distinguish these two types of information for a significant estimate, then applying the correction retrospectively is impracticable. For example, as per paragraph 53, you must disregard information about an unusually severe flu season that became available after the financial statements for the prior period were authorized for issue when correcting a related liability. So that's all about our presentation. Thank you for your attention.